Good afternoon, everyone. This Mohammed Ghafoor. I lead BDO's not-for-profit team across the North of England. Primarily, as many of you know, I do a lot of work in the social housing sector and lead that team across the North for BDO. So, the social housing update webinar today. Focus on the webinar today will be to give you a flavour of some of the changes going on in the world of audit, accounting and tax for social housing providers in particular. So particular focus from my perspective will be around some of the financial reporting changes, what some of the issues coming up post-Grenfell around accounting in particular, changes on social housing pension scheme, rules and acquisitions, really just a refresher based on the fact that a lot of organisations are going through these sort of transactions at the moment. So around change formatting of accounts, particularly the front end of accounts, and linking in some of the value for money stuff around that. And then some of my colleagues will talk around some of the VAT issues and CIS issues later on in the presentation today. Hopefully this should take no more than around 40 minutes. So in total with questions, but we'll see how that flows. On to the main detail. We're talking about financial reporting and the next phase and the changes flowing through here. So as many of you know that we went through quite significant change a couple of years ago now around FRS 1 or 2. And what came out off the back of that was a triennial review by the FRC. And that amendment to FRS 1 or 2 triennial review has now been published. And effectively it provides additional guidance for periods beginning on and after January 2019. But in the areas which I'll come on to in a moment, you could potentially adopt as well if you want to. But the key areas that have come through around the triennial review are around key areas around treatment of gift aid, definition of financial institutions, recognition of intangible assets and business combinations, definition of basic financial instruments, and replacing undue cost and effort, particularly around properties which are held within a group. The areas I'm going to focus on today are actually the ones that have relevance to social housing providers, with the gift aid piece, around the definition of financial instruments and replacing undue costs and effort. So gift aid, I mean, many of you will know that who work with BDO in particular, this is an area that has seen some change in terms of accounting treatment. I think the first thing to say around this is what I'm going to talk about today is purely to do with the accounting treatment. Tax treatment and gift aid has not changed. So the tax treatment on gift aid is that within 9 months of the year end, gift aid can be claimed. There's no change to those rules. What's changed is the treatment of that gift aid within potentially in the accounts. So for those of you who are BDO clients, you're more than aware that last year the way the gift aid is treated within a group set of accounts, within an organisation's parent set of accounts, effectively that treatment is shown as a statement of changes in equity and reserves rather than through the INE. And that change we did put through with our clients last year, but that's been further clarified by the FRC in terms of their approach around gift aid and the treatment of gift aid. What changed since that last year is actually can you accrue gift aid and how can you accrue gift aid? And that primarily is around the fact that previously all organisations were able to do was if they effectively had a board minute before the year end, they were able to say that we will accrue that gift aid in that year. So for example, for March 17, if you had a board minute in February 17, where subsidiary said that we are going to gift aid to the parent, this amount, that amount could be included in the March 17 accounts. The clarity from FRC around that has changed. So effectively what the FRC are now saying is either the only way you could include that amount in that period would be either if you paid the gift aid before the year end, or if you actually set up what's called a deed of covenant, effectively a legal agreement to transfer that gift aid across. That obviously a more detailed, or harsher, effectively in terms of the rules and the change in the rules around that, but that effectively is what's come through. However, what the FRC also say is that actually, if you don't pay any gift aid at the year end, and the intention is that the tax you are going to gift aid after the end. Within financial statements, there's no tax charge required in those instances, because you have the intention at the year end that you are going to gift that amount. So while you won't have an accrual for that surplus in the subsidiary account, what you'll have, you won't also need to put in a tax charge against that as well. I mean, clearly this is an area that is still, I think, organisations are still working through. Our approach on it from a BDO perspective is that we understand there's changes flowing around this, and that we are flexible around our approach around this. And clearly, if you have issues around gift aid and you have any confusion around how that needs to be treated, please speak to your auditors, and we can clarify that position for you. Okay, that mainly on the gift aid and the tax piece. Around financial instruments, actually, there's not really any significant change here that would impact on registered providers. There's some additional clarity around some of the description of what a financial instrument is and whether it's basic or unbasic. One area that there is particularly additional clarity on is around the issue around negative compensation clauses, which I know from experience of the clients I work with. There were some issues around whether the word should be treated as basic or non-basic instruments. Effectively, the clarity coming through from the FRC around this is that they are basic instruments, and from that perspective, the way your calculation around that, the way you treat that, is in line with what we see with a number of organisations. So there should be no change for RPs, significant change for RPs in their treatment of those negative compensation clauses moving forward. Cost is a particular issue around real focus here around the accounting policy impact. When FRS 102 came in, there was effectively a change in the rules around where organisations, where parents may own the property and it's rented to a subsidiary or vice versa, and effectively having to treat that element as an investment property. Actively under the new rules that are coming through from the FRC, in the case of investment properties which are to group entities, the policy adopted can make a choice around policy. You can either treat it at fair value or you can treat it at cost. So that actually removes the requirement potentially, if you treat it at cost, for external valuations. Okay, so in actual accounting auditing changes from the FRC, they're the three key ones, but clearly we'll see further changes as we move forward and when the new SORP comes out in the next 12 to 18 months. Grenfell, clearly the Grenfell disaster from a wider perspective has had a big impact on the social housing sector. The discussions that we've had with our clients around Grenfell is particularly around the clients have been impacted with regard to tower blocks, and whether they can capitalise any new improvement spend around cladding on those tower blocks. I think in terms of this, the view that we've taken, and I think this view is consistent across accountancy firms across the sector, is if you already have cladding as a component, then effectively what you do is you strip out that component and write that cladding component off to the I&E. You can capitalise your new cladding component that you're bringing in, your improvement spend, and then in addition to that, you then do an impairment review to ensure that your new value, there's no requirement of impairment against that. If If you have no component, then the rules that you apply is effectively, do costs enhance service potential of the asset? So effectively what that means is, do these additional costs increase rental income and reduce maintenance costs, or increase the useful economic life of the asset? I think all three of those are quite difficult to prove, and also what elements of cladding would you actually capitalise based on the back of the work you've done around proving that there is a enhanced service potential of the asset. The clients in this instance are writing off the cladding where they haven't got the cladding as a component previously. And as I said, it will be quite difficult to prove that it is actually adding value, because effectively what you're saying is the reason you're bringing the cladding on is because actually the cladding wasn't up to standard based on the environment that we're in today. So that's a difficult one to be able to justify. However, the way looking at this is on a case-by-case basis. So if you do have issues around cladding, or even anything around you're unsure around capitalisation, because those are effectively coming from FRS 1 or 2 and the SORB, so there's consistency in approach around capitalisation, whether you capitalise or whether you write it off, then please, any issues around that, please speak to your relevant auditors. A really critical area, I think, from a wider perspective at the moment, we're seeing a number of large providers pull out of the ships, and primarily that is down to the fact that those organisations want to be able to understand the liability moving forward and mitigating the risk around that liability increasing. From an accounting perspective, there's also an interesting time, because in the past, as many of you will know, where you do have ships, that there's no actual asset or liability shown for ships on your balance sheet, because the argument's always been that ships are not able to split out the asset and liabilities for the individual entities. That situation appears to be changing. There appears to be a lot of information out there now that ships are effectively saying, actually, we think we may well be able to split out the asset and liabilities for the individual organisations. And after that, I think the position that we are getting to around ships is that you have, and let's be honest about this, it's not going to be an asset, it's going to be a liability. You will potentially have a liability to put onto your balance sheet in the short to medium term. Highly unlikely that will be for this year end, and that's information that we're getting when we're talking to the key stakeholders who are involved in these discussions. However, I do think certainly for next year end, potentially you could have a large liability, large ship's liability on your balance sheet. Now, from my perspective, you need to be aware of this. You need to be aware of this from does this impact on your business in any way? And also need to be aware of this in particular, does it have any covenant impact? I think it's likely from what the covenants that we come across that it would have covenant impact, because I would imagine it'd be excluded. But clearly you need to be sure of that and make sure you're on top of that when this change happens. Okay, so around the pension stuff. So just moving on to acquisitions. I think actually nothing's really changed in this area. I think the reason we've put this in here is that we are working with a lot of organisations going through mergers, going through joining in partnerships with other organisations, going through acquisitions, and we often have a quite lengthy discussion with these organisations about how do they treat this transaction. Often, so what comes back to us is actually we want to treat it as a merger. This is how we internally are classifying this, and so quite important also from an accounting perspective that we also are consistent in our treatment. The few may well internally and from a corporate perspective see it as a merger does not necessarily align to the fact from an accounting perspective it will not be treated as a merger. There's certain set criteria within FRS 1 and 2 and the SORB in what can be treated as merger accounting, and for just clarity, merger accounting is effectively what you're effectively saying there. That the organisations have always been together; they've always been combined. So effectively, what you do is you add the two balance sheets together. to get merger accounting. It's a much more simpler process as opposed to acquisition accounting. We're actually saying that one entity is acquiring the other entity, and you actually have to fair value the assets in terms of making sure that you get that correct. I think around merger accounting, the criteria in accounts is quite tight. So you've got criteria around what does the merged entity in terms of control look like? Is it properly managed? Is it the fact that both entities have 50, the board is 50% of the old boards on both sides, and not a case of one entity having more than the entity in terms of ownership. In terms of size, are they equivalent in terms of size? There's a number, I think it's 5 or 6 criteria that have to be met. So if you go down this road, it's a natural given that you'll end up, if you are talking about a merger, etc., the accounting treatment may not reflect that. So just be aware of that. In value for money, an area of significant change. I'm not necessarily going to focus too much on value per se. It's more from accounting perspective, because in the financial statements, as you know, in the front end of your financial statements, what I had in the past is quite lengthy value for money statements, which were based on the old value for money standard. That is changing in terms of the requirements from the regulator around the value for money standard. The requirements of the regulator are focused on key metrics, which we expect to be issued within the financial statements. And this is based on the VFM consultation, and the final version of that still to come out, but that should come out almost any day now. Those metrics are on the slide in front of you, so these are the key areas of focus that are required around VFM. What will that mean? Well, that will mean actually the requirement of having that incredibly lengthy statement in your financial statement is not there anymore. The requirement to have actually a separate VFM statement is not to put on your website is necessarily there anymore. But what you will have to do is ensure that these metrics are calculated and in your financial statements. I would imagine that you would also to ensure that you have some commentary around this, to ensure that this is that you explain your reasoning behind this. These metrics are going to be critical. The regulator for social housing will be focusing on these metrics, will be benchmarking you against these metrics, against others and your peer groups. So the way these metrics are calculated is going to be quite critical. A lot of these metrics are going to come from your financial statements, and a real focus, particularly on notes 2 and 3 of your financial statement, particularly around the way your allocation of costs, which can impact on some of these metrics in a significant manner. I think this year it'll be a case of organisations will be looking at each other and thinking, well, are we distant in the way we are producing these metrics in terms of what costs are going in, management costs, what costs are going in, planned repairs, what costs are going in response repairs? Is there consistency? Clearly, is significant inconsistency that can have an impact on the numbers. Certainly, from our perspective, in terms of auditors, we will be looking at the consistency across our client group and the clients we work with. I think what we'll see also is organisations also talking about what they put in their costs in terms of getting these numbers, and I think the regulator also would be interested in ensuring that there is some consistency approach in the way these numbers are calculated. In terms of the mix and those, and there's some pros around and cons around some of those issues I've just talked about. Around VFM, about how that all then links into your wider VFM strategy. But interestingly, I've talked to a couple of clients on this. I'm still talking about doing a VFM statement, but that VFM statement will not go in your financial statement. It would just be on your website for your stakeholders. So just to demonstrate, the areas of focus that you got, because clearly the VFM statement that have been produced in the past, certainly they have provided significant added value to stakeholders about what social housing providers are doing and how they are meeting some of those key requirements around VFM. So just next, in terms of accounting and auditing in particular, I think additional guidance around financial instruments and the treatment of financial instruments, quite a very complex area. A number of issues came out from the initial FRS 102. I think that there'll be further clarification coming through around this area in the short to medium term. Revenue leases, world of IFRS, this new standards have been issued around revenue and leases. And revenue applies to the social housing world. I don't think there's any significant change to expect around that. Leases, however, effective IFRS is effectively stating that there's no such thing as operating leases moving forward, and all leases will go onto balance sheets. So that's an area that, you know, I know of sometimes organisations from a wider perspective looking at keeping things off balance sheets. Certainly IFRS will be driving the other way, and I expect that to flow through into UK GAAP as well. And I think there are other issues, and you know, certainly we'll be getting a new SORP in the next 12 months. The new drafts around that. There'll be discussions around some of the issues coming through from that. And what will be interesting around that is that the sector itself is becoming more and more diversified and more divergent in what it does, and the SORP deals with some of those issues. So that's really it for me in terms of the auditing and accounting update. What I should have said at the start is there's opportunity clearly for you, the attendees today, to be able to ask us questions, and so you can ask us if there's any questions that anyone wants to ask around any of the issues I've raised. Please just type into the screen and they'll come through to us. Or you can also contact me separately. No issue with that at all. But I'll pass you on to my colleague Jim Gempton, who'll talk more around some VAT considerations.
Okay, thanks, Hamid. Hello, I'm Jim Gempton. I'm a VAT specialist working in BDO's Northwest offices. Always much to talk about where VAT is concerned. The providers are VAT registered, of course, but because of the large income from rents, they don't get all their VAT back on expenditure. Exemption means that some RPs get low single-digit percentage VAT recovery on overheads, and anything wholly attributable to social rents is totally irrecoverable. Compare maintenance to housing stock into this irrecoverable category. So what expenditure spike through a combination of unforeseen external factors? The Grenfell tragedy and the subsequent unbudgeted cladding rectifications is just such a situation. All political pronouncements, such as the Chancellor saying in his recent budget speech that funding will be found, it would have fallen to the RPs to fully fund the expenditure required themselves. Of course, for a stock transfer, many RPs have the benefit of a VAT shelter arrangement. This sits alongside the usual rules about VAT recovery and enables the VAT on major works to be fully recoverable. Whether the VAT on expensive cladding works post-Grenfell could possibly be included in this VAT shelter arrangement. I think the simple answer to that question is no. Colin asked the same question about cladding works several years ago, well before the Grenfell disaster, and advice at that time revolved around checking whether the expenditure was included in the schedule of works, which was usually in place at the outset of a shelter arrangement. My recollection from that time was that such works weren't included. However, if the schedule of works is drawn so widely as to make a case for the inclusion of cladding works, and if there's sufficient time and budget left in your existing shelter arrangement, there may be scope to include the post-Grenfell expenditure. Given though and the amounts involved, I would, as any RP looking to recover the VAT in this way, to consider making HMRC aware that they intend to do so before they actually do so. RPs have floated the potential for a completely separate shelter type arrangement to cover the post-Grenfell cleaning costs. It could only be a central government decision, one that would have to be imposed by the Treasury on HMRC, much like the original shelter arrangements were way back when. I have to say I've heard nothing encouraging on this score so far. I also have to say I think anything along those lines is extremely unlikely. Maybe I'm a pessimist, pessimist, but I've learned to only believe things when I see them, especially when HMRC concessions are concerned. More in is some recent case law in relation to valuable zero rating for residential building works, where there is an existing building there before, and that existing building has not been totally demolished. First, demolition works themselves can be zero rated where they are clearly in contemplation of residential building works. There needs to be a temporal link between demolition works and the construction phase, and only then can the demolition works be said to be works in the course of construction. If a block of flats is demolished because it's unsafe, and the owner has got no immediate plans to build on the cleared site, or at least will leave the site bare for a while, demolition works are likely to bear VAT at the standard rate. Often there's a prescribed time limit whereby the demolition works will definitely qualify or definitely do not qualify for zero rating. There isn't. Any more than a few months though, and I'd say you'd need some pretty compelling reason for delay and the potential break in that all-important temporal link. There's been a local authority planning issue which necessitates some delay. If so, document it and keep it handy in case there's ever a challenge by HMRC. Your contractor or special demolition contractor, if you're using one, will be ultra keen to get the VAT liability right, as it's they taking the risk up front if they zero rate when they shouldn't. You don't contract for the demolition work, or the same contractor for both the demolition and the new build. The car is that temporal link between demolition and new build residential construction. That, and you get the zero rating. The recent case law I mentioned, the Astral case has quickly become one of my favourite ever VAT cases. And yes, I do have favourite VAT cases. The Astral case involved the building of a new care home which incorporated a disused church. Basically, the church building formed the reception and office areas of the new care facility. We build constructions either side as wings, with residential accommodation in those wings. Before clearly visible when the works were complete, it led HMRC to argue, not very surprisingly, that it wasn't a new build care home, but rather an extension or enlargement of an existing building. Of course, an enlargement of an existing building is rated for VAT purposes, so the cost of the project increased by 20%. And as we say, VAT on a big figure is a big figure, and in the Astral case, it was a lot of money and well worth arguing about. The judge, perhaps surprisingly, agreed with Astral that the size, shape, function and character of the finished care home was sufficient to justify the term new build and make it for zero rating. Surprisingly, because that is counter to everything HMRC had ever said in the past. The church building comprised only 15% of the new structure, completely dwarfed by the new works. Appealed the first tier tribunal ruling to the upper tribunal, and they were confident the decision would be returned, but instead it was upheld. Even then, HMRC made noises that while they disagreed with the decision in Astral, they wouldn't appeal it, as they thought the circumstances would not happen that often. They were more interested in winning the separate case of J3 building. This involved the extension of a single household dwelling, where not all the original dwelling had been demolished to ground level. HMRC did indeed win the J3 case. These are then HMRC publishing new guidance on what is and isn't, in their view, a new build, where an existing building is incorporated rather than totally demolished. And I'm with a client to prove to HMRC that their case, which was a new care home incorporated in an undemolished building, is what we've come to refer to in that correspondence as more actual than astral, and therefore qualifies for zero rating. Convinced HMRC the VAT saving is £250,000. So it's worth keeping an eye on VAT case law, and that's exactly what has given this particular client of mine the opportunity to make a major VAT saving. And with that, over to Nick on CIS.
Good afternoon, everybody. My name is Nick Duffin. I'm an employment tax and construction industry scheme specialist based in the Northwest. A potentially complex area, depending on facts. Today, it is a high-level commentary for general awareness to allow you to consider how CIS may apply to your organisation. As you can see from the agenda, we're going to identify briefly what is CIS, what is a construction operation, how that forms a construction contract, and consider the relevance to the social housing sector with a particular focus on development companies, and then touching on the dreaded penalty position if things go awry. So this is a piece of legislation which is used by HMRC to monitor payments made for construction services provided. So it allows HMRC to ensure the correct amount of tax is accounted for by a party in the supply chain. What's for today, this is a piece of classic anti-avoidance legislation. It says any payment made under a construction contract, when one party engages with another for the provision of construction services. So it's to understand how to identify a construction operation. A operation, or commonly referred to as services within the scope of CIS, works which involve the demolition, construction, operation, repair, maintenance or site preparation complete on land, property or building. It's obvious what is a construction operation, but there are areas where it's quite unclear. And so legislation and guidance is our primary starting point for determining if any services commissioned are within the scope of CIS. Once a construction operation is being commissioned, allow you to identify and confirm whether or not a construction contract has been entered into. But a construction contract is any agreement, whether implied, written or verbal, under which one party, the subcontractor, agrees to supply services which are a construction operation to another party, the contractor. Types of construction contract: a supply whereby a separate contract for each construction service is entered into, or a mixed supply which can include both works that are within CIS and works which are outside. Where you supply under one contract, the full contract is caught within CIS, and the contractor must consider the full elements of compliance. Once a construction contract is entered into, the next step is to identify who is the contractor and who is the contractor. As before, who is going to work, the contractor, and who will be responsible for delivery of services, the subcontractor. Social housing, because you probably don't regard yourself as a mainstream or a contractor or a builder. Well, your contractor is caught in two ways, or defined as two ways. First, it's any organisation which carries out a business, which includes construction operations. So think about it, things like a house builder, a civil engineer, road building firms, utility companies, and on. They will be classed as a mainstream contractor. However, and more importantly, the contractor is also caught under the scheme if, while construction doesn't form part of their main business, they spend an average of £1 million per annum over a three-year consecutive rolling programme on construction operations. This would capture organisations such as trusts, banks, local authorities, councils, and of course those in the social housing space. What's important to understand is the CIS regulations apply equally to mainstream contracts and deemed contractors. The only possible exemption is if you're a registered charity and are commissioning works, in which case you're not obliged to operate CIS. The final point about whether or not you're within the scope of the scheme is any individual entity which provides services to a contractor is deemed a subcontractor. If you have an organisation which provides services to a third party, which has construction services, then that is a subcontractor by definition. If you think of CO or DevCo, this will often have been set up to provide building and maintenance services to an organisation, typically main social housing company or organisation, and while that organisation may be exempt from operating CIS if they're a registered charity, the DevCo may begin to provide services commercially to other third-party organisations which are not registered charities. In this case, the services that are supplied are likely to be in the scope of CIS, then a DevCo must register as a subcontractor with HMRC. At this time to go into the details around what subcontractor obligations are, it's key to ensure that you are compliant, otherwise there could be impact on cash flow. As interest in respect to compliance, DevCos have matured. We've found they're often used to become a contractor in its own right. For example, where the co commissions a third party to develop and build housing on certain parcels of land. In circumstances, whilst the DevCo may already be registered as a subcontractor with HMRC, it must become a contractor registered as such with HMRC. What that is, there are certain obligations to be completed, such as verifying the employment status of any individuals engaged, confirm the tax status of any subcontractors who are paid, if appropriate, deduct and remit CS deductions on payments made to certain subcontractors, and also submit monthly returns to HMRC. Each organisation within a wider social housing group could be deemed as a contractor, not just a DevCo. The report to understand whether or not you have an organisation that is a contractor is where that contractor engages with a subcontractor who has a net payment status. In those circumstances, the contractor must apply a 20% deduction to the value of the invoice presented. There is COA in that any cost of direct materials incurred by the subcontractor can be repaid gross. However, what's important is the responsibility of the contractor alone to satisfy itself that any material costs included in the invoice are the direct material costs of that subcontractor. In the event of failures to correctly operate and apply CS deductions on payments made to subcontractors, HMRC will pursue the contractor to settle any underpaid CS deductions in the first instance and will also seek to apply penalties. Whilst there are circumstances where HMRC may not pursue any underpaid CS deductions from the contractor, clearly important to ensure that compliance is achieved in the first instance to reduce potential penalties, a lot of time and energy spent dealing with the errors. Finally, I mentioned there are two penalties under the CIS. The first is those which occur where you fail to complete and return your monthly returns to HMRC. As seen on the screen, there are three elements to that. The first is if you have a return which is a day late, there's a £100 fine. If it's 2 months late, then it becomes a £200 fine. It remains outstanding at 6 months, for the £300 fine. It's also worth noting that if you have actually paid a subcontractor where CS deductions should have been applied, HMRC will levy a further penalty of 5% of the value of CS deductions which should have been applied. Also, on that particular slide, you'll see there's further charges in the event that those returns remain outstanding at 12 months. And finally, there's also a further potential penalty where HMRC identify that you have failed to complete your monthly returns correctly and have omitted any CIS deductions. If there is any CIS deductions which have not been paid out of a HMRC, the HMRC have the ability to charge penalties on a tax geared basis. As seen at the bottom of that slide, there are three levels of potential penalty, which depend on the seriousness of the error or omission. That's the brief element of CIS. I'll pass you back to Ed to bring the webinar to a close.
Thanks, Nick. Thank you very much. So, that in a nutshell is the key elements of our accounting and tax updates. And I think what you can hear from that is that there are some changes flowing through, but certainly audit and tax side, there's nothing significant that's changed over the last 12, 18 months. But believe some potential things that could happen in the future could have a significant impact. In terms of questions, I think a couple of questions have flowed through, which we're delighted about because we were worried no one would ask, but that's great. So the first question that's come through is around the new VFM standard, about when it's going to be published and is it effective for 2017-18 accounting period. In terms of published, my understanding is, and clearly I'm basing it on what other colleagues are telling me and also talking to people within the sector, is that it should be the next couple of weeks. It should be in March, is my understanding of when that will be published. Consultation finished back, I think it was last year they actually finished. So there's clearly debate around that consultation at the regulator. It should come out quite soon. The 2017-18 accounting period, my understanding is yes, it will. So what I talked about before around the changes in value for money within the financial statements, my understanding is that it will impact on 2017 and 18. So it will state that this needs to be done in your 2017-18 financial statement. Clearly that may change within the final statement is actually issued, but the intention to talk to people at the HCA, the regulator social housing now, it's not HCA, regulator for social housing, and talking to other consultants within the sector is that it relates to this end. Second question we've been asked is around the change in accounting for leases. In a way, what we're talking about is what we're seeing come through from IFRS and the trends around that. Often those trends are aligned to UK GAAP. And actually, we know the FRC are really keen to align UK GAAP more with IFRS. Until that flows through, one would expect that to start flowing through at the next review of S102. So probably looking at the next, probably around 12 to 18 months, and then a little additional period on top of that around that actually will be implemented. But yeah, what I would say to you is around that is that I think that the leases piece is something that's been debated within across the UK from a wider perspective for a significant amount of time now, and certainly the direction of travel around leases is it will be on balance sheet. I think that's pretty certain. When that happens, it's probably a little bit more uncertain, but definitely I think that is going to happen. Okay, the two key questions. One other question which comes through for Nick, which from the chat, Nick, it's more around you talked about CIS, but are you seeing practical difficulties in organisations applying CIS?
We are seeing more of it, particularly with the use of development codes as they are being utilised to the new builds and development sites, where they change from being purely a subcontractor who would have supplied services quite often to a registered charity and therefore out with the CIS scheme. They become contractors because they enter into large contracts with third-party house builders, developers. And at that point, there's sometimes a misunderstanding that there is some protection. They are part of a group where one of the group companies is a registered charity. HMRC are very clear that CIS is an entity-based tax, and therefore each entity must be considered in its own right. And the secondary part to that is quite often the development company is being presented with large invoices or state payments and pay over those when there may in fact be a requirement to consider whether there's actually any direct material costs. So there's some required to ensure that a third party has a net payment status and CIS deductions are applied to ensure that where material costs are presented, that they genuine and direct costs and do not include any margin or markup.
Thanks, Nick. Okay, so I think that sort of brings us to the end of the webinar today. It's certainly our intention to do more regular webinars, and not just on. This was the first one that we've done, and this is on obviously very technical. I think what we are going to look to start doing is more for leadership-based webinars about some of the issues impacting on social housing in general, and as I'm sure you all are aware, there are a lot of issues impacting on the sector at the moment. So just for me to say finally, thank you very much for listening in today. If you have any comments or queries or questions, please contact any of the panelists today or Phil Ward, who has been managing this whole process, and we're more than happy to take those on board. So thank you very much.